so much for watching our podcast, Real Estate Insider, where America goes for funding. For the last 20 year guys, your direct nationwide lender. Appreciate all of you guys watching the show on the channel with Angelo Christian. Every week we do our talk with Angelo live once a week, and we have like 3 videos that we push out. We talk about real estate, investing, loan products, new things that are coming out with commercial, residential. Like I said, we're a direct nationwide lender. We do commercial, private loans, hard money, construction, conventional, jumbo loans, HELOCs, bank statement loans. So, and you know, we just talk about everything about loans. So, and finance. So if you have any questions, we're open 7 days a week. Call or text my office, 832-431-6331. You can go to our website, officialangelochristian.com, our Instagram, our YouTube. And if you have any questions, you know, hit us up down below if we can help you. You know, we're happy to help you, give you any information that you need. And then, you know, every week I come out with different things that we're talking about, what's going on in the market, what's going on in America with real estate, finance, investing, and stuff like that. You know, and we're actively participating as a lender to get deals funded. So, so I'm going to talk about a few things tonight. If you guys have questions, you know, feel free to ask those questions. That's why we're here. And you know, we've been doing this on YouTube since 2015. We have about 9 million views, almost 70,000 subscribers, like 1,600 videos. So go and check out our library if you want more information. If you have a loan scenario, you need help with loan funding, please reach out to us, call us, text us, 832-431-6331. So basically, one of the first things that I wanted to talk about, we're going to be talking about, you know, trying to get a loan when you have 2 jobs. What we've seen a lot, especially in the last, let's say 5 years, is a lot of people have 2 jobs. Some people even have 3 jobs and they're trying to get a loan. And a lot of lenders, they don't approve people if they have multiple jobs. They only approve you if you have 1 job, or if you have more than 1 job, you have to be on those other jobs for at least 2 years as well. So I think it's important because we see it a lot, and a lot of people, you know, they have this mindset, well, you know, I've had my main job for a long time, and then I just started my second job. I should be able to qualify, you know, for the amount of house I want because I have the second job. But unfortunately, it just doesn't work like that in the lending world. If you have a second job and you just take it on that second job, you automatically just don't get credit for it immediately. Generally speaking, you know, you need to have at least a year, ideally 2 years of holding 2 jobs at the same time in order to use that secondary job income. So basically, let's say you work at FedEx, you make $70,000 a year, you've had that job for 5 years, and then you get a job, you know, working for UPS, and you just started this month, and then you're making $40,000, and you want to buy a $500,000 home. Well, you're not going to be able to do that because, number one, the first job, you don't make enough income to buy a $500,000 home, and then we can't use the UPS job because you haven't been there for at least a year, or preferably 2 years. So you have to have 2 jobs at the same time for at least a year in order to consider both jobs. The same thing goes if you're using bonus income, overtime income, any variable income, you have to have it for at least a year, ideally 2 years, in order to use that income, okay? So I hope that helps you guys out there because, hey Kevin, good evening buddy, thank you so much for watching the channel. So, and anyone that's watching, please give us a thumbs up, give us a like, subscribe, share this with your friends, family, colleagues. We work really hard to get you the content, educate you, empower you, give you the information. So appreciate all of you guys checking us out. So, so with that said, talking about more qualifications for loans. Let's say that you went to school and now you've graduated and now you're working in your career. So there's a 2-year history requirement for a loan. Now, it's not just 2 years of work history, it's also 2 years of school history too. So if you have a total combined cumulative 2 years of school and work, you can use that for purchasing a home. A lot of people think they have to be 2 years at their same job in order to be eligible to get a loan for a property. It's not true. You could have just graduated, got your undergraduate, and now you're working at your career, just been there a week, and you add the school plus the work to get your 2-year history. You don't have to be 2 years at the new job. You could have been working 4 jobs in the last 2 years. As long as you have a 2-year total history, then you can use that. Okay? So just want to make sure that everybody understands, because a lot of people still think in their head that they have to be working 2 years at one job in order to qualify for a loan, and it's not the case. So keep that in mind. Now, talking about lender requirements, a lot of people, unfortunately, you might not know this, but it's a pretty interesting fact that 60% of the loan applications actually get denied. So I thought it's actually worth talking about, why do so many loan applications actually get denied? And a lot of it has to do with if you don't fill out the application correctly, you put the incorrect information on the loan application. It could be something with your credit score, your income, your debt ratio, something wrong with the property. So I thought it was important to talk about that to help what can you do to improve your chances, to qualify for the loan. You want to make sure you have the best credit score that you can get. Now there are some loans that are not even credit score based; they're asset based, and they have nothing to do with your credit score. And it's not just because if the property's in bad condition. There are loan programs out there that will give you money to fix up the property too. So there's different type of loan programs that are available to you that you can get the funding to fix up the property if you need funds for rehab or construction. And we offer those loans, okay? The other thing is debt to income ratio. This is what we see a lot, especially right now. When you have if your debt to income ratio is too high, you may have to do a no ratio loan or a no documentation loan, or you may have to put more money down or bring in a cosigner. Usually the way it works is, lenders are going to lend, 3 to 1 with your income. So if you're making $50,000 a year, you can probably buy a house for maybe $150,000 to $200,000. If you're making $50,000 a year, you can't buy a house for $700,000. Then the math doesn't compute. It doesn't matter how high your credit score is, right? So you just have to have realistic expectations about that. And that's kind of the thing, that what you want, is a lender to be real with you, because it's not about friendship or fantasy or just pretending. It's real stuff. You guys are wanting to borrow money, and it's a serious thing. And now, obviously, no one should ever be rude to you or mean to you, but you want someone that's going to be straight and tell you what it is, and then show you paths to get there, right? And that's what we do. We're going to come up with the routes to help you to make it happen and get it done in a realistic way. Okay? So that's the things I want to talk about in regards to loan qualifications and guidelines. Some other things that I do want to bring up, we talked about our loan partner program. We're in the middle of rolling that out. If you're someone that generates a lot of customers, you're a broker, you're a realtor, you're a builder, you're a developer, we have a loan partner program that we're rolling out where you can join our team. You actually become a member of our team, and then any referrals that you bring in, you can actually get paid on them. So if you want more information, you can generate at least 10 customers a month for us. You can join our loan partner program. Call or text us and just put in the text line loan partner program. The requirement is you got 10 plus referrals a month. Then we can go through all of the ins and outs of joining our team and how the pay works and everything. But the loan partner program is very strong. So if you want more information, if you're someone out there, you're a big networker, you got a huge database, huge clientele, the loan partner program is really, really good. So Maybe you have a big social media following. I don't know what you have. Maybe you're a builder, you're a developer, you're a broker, or whatever. But the loan partner program is going to be really, really cool. If you want more information, like I said, call or text us about it. But, kind of to give you an example of what that looks like, you're going to join our team, be on our team with us. Let's say that you send over, 5 referrals that month that close, and, that's, equivalent to, $20,000 in commissions. That's what your paycheck's going to be. Okay, so I don't know how much the commission is going to be on each one that you send over. I'm just giving an illustration so you can understand how it works. But it's an awesome thing, when you join our loan partner program, because you might have a huge network. So that's what it's for. Someone that has a big network that you want to expand and grow your network and make more money and refer customers over to us. That loan partner program is solid. So anyway, that's what that's about. Going over to no doc loans and no credit score loans, I want to talk about that for a second. We get a lot of customers that inquire about no doc loans, and I just want to remind everybody out there that a no doc loan doesn't mean that you don't do anything and the loan just closes and funds and the lender doesn't ask any questions. That's not what no doc loans are. So no doc loans means that you're not verifying your personal income to qualify to get a loan. Okay? You still have to go through an underwriter. You got to do appraisal, inspection, and conditions, requirements. They're going to ask you things. You have to send things in. And in a loan process, you're going to continue to supply documentation all the way to the end. That's how loans work. Okay? They don't, just, ask you a couple things and then you just supply your initial information and they approve the loan and it funds. It doesn't work like that. Lenders are going to ask you for things all the way to the end of closing, and you have to provide them if you want to close on the loan. If you don't want to close on the loan, then you don't have to provide it. But you have to have an attitude of, being submissive, getting it done, cooperating, so that's really the mindset if you're going to close and get a loan. They're going to ask questions. You got to supply the data. Some things you can argue, some things you don't have to provide. But, all in all, that's kind of how it works. But yeah, no documentation loans. They don't mean that you don't do anything, we don't get anything, we don't care, we just fund the loan. There's no lenders out there that do that. So I just want to make sure that you guys are aware. It just means that you're not providing your personal income. You still have to go through the entire loan process. Okay? Now, no credit score loans, I want to talk about that for a second, because there are a lot of people that either don't have credit or they have bad credit and they want to do asset-based loans, and they ask about asset-based loans, no credit score. So I do want to bring that up for a second. So asset-based loans, they don't have credit score requirements, although it would help if you had a good credit score to get an asset-based loan, but they don't require it. So you can do, usually 50 to 60% loan to value on a property without the lender, digging into your credit score. Okay? You're going to pay for it. It's a more expensive loan. That's okay, because it still suits a purpose. It'll be a higher interest rate, more closing costs, but it will suit a purpose for you and help you to get the loan done. But asset-based loans are out there, and they're not credit score driven. The underwriting is done on the asset, the property, and not on your credit score. They're making a decision based on the property and not you. Okay? And that's all it is. They are more expensive than conventional loans, but sometimes people need that in order to get the job done. Now, a lot of people will use an asset-based loan to qualify for, the first round of funding, and then they'll pivot to, the second round of funding for a long-term loan. Once their credit score or the property is in a different state, then they'll either refinance or go to a different program or sell the property. A lot of people use asset-based or bridge loans for fix and flip. An investor that wants to buy a property close fast, they don't have time for banks and conventional loans, 60 days for processing. They need to close in a week. They're going to pay a higher interest rate and more closing costs to get the loan done. That's how it works. So, no credit score loans are out there. We do them. And it's just understanding why to use it and how to use it towards your advantage to take you, to the next step so you can get what you want. And so it's about you monetizing and using the lender's funds to help you to grow your equity and build your net worth, right? And sometimes it makes a lot of sense. We have some customers that they use asset-based loans and they make a lot of money with it. So you just have to have a really good plan, a good exit strategy about what you're doing with this loan. And it can work, very strong for you. So that's that. One thing, shifting gears a little bit, I do want to talk about is prepayment penalties. We get a lot of people asking us about prepayment penalties. So I want to make sure everyone knows what a prepayment penalty is. Now, you cannot do a prepayment penalty on a primary resident. That's prohibited. But prepayment penalties come on a lot of commercial loans and a lot of investment loans, okay? And basically what that is the lender, when they make the loan to you, it's very expensive to make a loan to the lender. They want to make sure you stay on that loan for a while, especially if they're giving you a low rate. So a prepayment penalty basically is just saying, look, you agree to stay on this loan for at least 3 years. And if you don't stay on the loan for 3 years and you pay it off the whole balance before that, you have to also pay us, in addition to the balance, usually 6 months of interest. So they want to get something in return for doing all this effort to make this loan to you. So they usually charge you 6 months of interest if you pay off the entire balance of the loan within 3 years. Now, you can always prepay more towards the principal within 3 years, but paying off the entire balance, they'll normally want you to prepay something. Now, not every loan has a prepayment penalty. That's an investment property. And not every commercial loan has a prepayment penalty. But if it does, that's usually what it looks like. So you can prepay that 6 months of interest if you pay off the loan within 3 years. Now, after that 3-year time frame, there is no penalty. It's lifted, and you can pay off the entire balance. So you can pay off the entire balance any time. It's just if you do within 3 years, you are going to have to pay a penalty for doing that. So, but you can also buy out of the penalty and opt out of it too, if you don't want a prepayment penalty. But it's just understanding what you're trying to do. Obviously, if you're going to be in the property for short term, then you don't want a prepayment penalty. But if you're going to be in there in the long term, you want a prepayment penalty because the rate's going to be lower. For example, if you do a rental property and I give you a 30-year fix at 8%, and it has a 3-year prepayment penalty versus no prepayment penalty and a rate of 11%. So you got to think about it. Do you want an 8% rate or do you want 11%? Well, the question is going to come down to what are you going to do with the property. If you're only going to be in it for 6 months, then you don't want the prepayment penalty. But if you're keeping it there as a long-term hold, then you want the lower rate. So you want the prepayment penalty. So just be mindful of that. It's not a bad thing. People think negative when they hear the word prepayment penalty. So Adrian, would it be worth it to cash out, refinance, or would you keep it and pay off? Are you asking, does it make more sense to do a refi or a HELOC? Was that your question? I want to make sure I'm answering your question the right way. It came by kind of fast, but are you asking me which one's better? Oh, okay. Well, that's also, the thing is, what are you going to do? What's your plan? My thought is I always like HELOCs better. We have, 10 and 20-year credit lines with us. Some of them have 20-year amortization, some have 30. I like those better because it's like a revolving credit line, and you can take money and pay it off whenever you want versus, getting a lump sum. Because even with the HELOC, if you pull it all out, you can pay it back and then pull it out again. I think they just make more sense, And my thought is always to want to borrow money when you don't need it versus borrowing money when you do need it. Usually when you need money, people don't want to give it to you. But if you borrow money when you don't need it, that's the best time. In a HELOC, you can store it away for future use. So I like the HELOCs better. I think they make more sense. We do first and second lien HELOCs here on primary residence, investment homes, secondary homes. And they just, to me, they just make a lot more sense. You know, a revolving credit line, you know, versus a lump sum payout. Now, I think that obviously a lump sum payout does make sense in certain situations. Maybe a divorce settlement, a business buyout, something like that. But, you know, generally speaking, I think a HELOC is a lot better. So I don't know if that answers your question or not. So those are some of the big things I want to talk about tonight. The last thing I want to finish with, you know, if you guys are out there and you're trying to buy a home, kind of what we're seeing the trend is right now, you know, it's a great time to be thinking about buying a house. We have a program, and you do not have to be a first-time buyer, where you can get up to $25,000 for a down payment and closing cost assistance. So you can buy a home up to $500,000 for your primary residence. It can be a single-family home, a duplex, a manufactured home, and you can get up to $25K down payment assistance. So literally, I had a client in Georgia today. She's buying her home for $332,000 and buying the house with no money down. You know, and you don't have to be a first-time buyer. If you have at least a 620 or higher credit score, then you're eligible for single-family, 660 for duplex, and 680 for manufactured homes. Well, look, I mean, it makes a hell of a lot more sense than renting. Rent's gone up through the roof. So you could buy a home right now and still get zero down financing. It's out there, you know. So it's a really good deal for people, and there is no income limitations. You can make as much money as you can, and it doesn't matter. And you don't have to have the best of credit, and you don't have to be a first-time buyer. So just putting it out there because, you know, it's really strong, and it's giving people opportunity to be able to purchase a home. So $25,000 is a lot to help towards, because a lot of people, like, they can make the monthly payment. It's just hard for them to come up with all the closing costs. Think about it. You buy a $500,000 home, you're coming to closing with easily 40 grand. And a lot of people are scrambling to find out, you know, how to get lunch money. So, you know, you want to try to get some help here. This is a way to help you to be able to purchase your house. So if you're out there, you know someone needs help with financing, you know, reach out to us. We want to be able to help you guys to get you the pre-approval and get it done. You know, we lend nationwide with these programs. That's why we're here. So anyway, I appreciate all of you guys watching the show on the channel. You know how much you mean to us. We're here. Call, text us, 832-431-6331. Go online to our website. If we can do anything for you, hit us up. It's where America goes for funding, guys. Your direct nationwide lender for the last 2 decades, Angelo Christian. We appreciate all your help and support. Take care. Stay strong. We love you. Have a great weekend. Bye-bye.